Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Paris Rapeseed. We've had two patterns here, two completed patterns, one of which is still the main influence on this market since as far back as summer last year. Is the extension to the bright red neckline, currently at 445 3/4 of the May to August 2025 Head and Shoulders continuation pattern. The move up from this bright red neckline failed twice in late October and again in late November at the dark blue overhead neckline extension, currently at 484.5 of the August to September 2024 reverse Head and Shoulders bottom, forming a small double top in the process. The downside primary and secondary targets for this small double top were duly reached in December last year. However, prices overshot the targets on the downside, dropping down below the bright red neckline extension. Yet, this neckline, along with the 50% absolute Fibonacci line at 445.5, well, they eroded the bearish pressure seen at the time, such that the very start of this year has been the lowest we've had since March 2024. The market then rose, creating a November 25 to January 26 diving board pattern, from where a fairly flat area, the market initially dives down as if into a swimming pool and then pulls up and out of the pool. We've already reached the pullback target area as prices overshot the upside, moving up over both the green short medium moving average, currently at 464.25, and the mauve medium moving average, currently 468.75. But then halting at and just over the fairly flatlining gold long moving average, currently at 475.25, before turning down and having a changeover gap lower between 471 even down to 457.75. As it's not unusual even for changeover gaps, the market had since the start of February tried to fill in this gap, but is running up into the same resistances that we saw in mid-January, namely the green short medium moving average, the mauve medium moving average, the June 21 low at 468.75, and the 50% Fibonacci line of the May 23 to January 25 move at 467.25. We've been trying to push up through these resistances for nearly 2 weeks, and I'm starting to get a little impatient, as if we will after all. However, if we do, and even now I suspect we might well do, then we still have what capped the market above in January, and that's the flatlining gold long moving average above. And then also what capped the market in Q4 in 2025, and that's the dark blue neckline extension further above. Winnipeg Canola. Prices had previously been capped in November last year, unsurprisingly, by the then slowly declining medium moving average, currently at 640.5, and the flatlining gold long moving average, currently 662.60. Further above these is what may be in some ways the additional cause to this halt back then, and something that is now today affecting the market. The significant bright green April to August Head and Shoulders top neckline, currently 687.90. Now, please remember this feature as it's been capping the market once again these past 2 weeks. Thus, at the end of November last year, we ended up with a small November and early December 2025 base double top, with the market subsequently crashing down and in the process reaching the primary and secondary targets for this small double top. I opined 9 weeks ago, and I quote, "Now in truth I favoured the basing action idea here, but it looks like the 50% absolute Fibonacci line is not going to stop the decline, in which case we could next be looking at congestion at 575. It all depends on if the 606.90 50% absolute Fibonacci line can hold." End of quote. In truth, the 50% absolute Fibonacci line, the one at 606.90, did not hold the market, but it did erode the bearishness enough that we formed a small double bottom pattern over the end of December last year and the start of January this year. The move up since reached both the primary and secondary targets topside, and 2 weeks ago we pushed up over the important flatlining gold long moving average. Prior to breaking higher over this moving average, as prices formed the hesitation part between the middle of January to in a bullish halfway hesitation. Last week I spoke about this, and today I can lay out a topside target X for this pattern up in the 715 area. This will not be an easy target to reach, as we not only have the previously mentioned bright green neckline to break, but also the 50% Fibonacci line of the July 23 to September 24 move at 70030, plus all the congestion overhead from that very same head and shoulders pattern between April and August last year that created the bright green neckline in the very first place. Bursa Malaysia crude palm oil. To start with, as I've done for most of last year and now into 2026, I'd recognise the wide congestion area that's overhead between 44.08 to 45.59. We tried in mid-October last year to pierce it and failed, with prices punching back down through the lower edge of this congestion as we exited October. On the way down, prices dropped down through another wide congestion zone made up from the 38.2% Fibonacci line of the May 20 to March 22 move and the 50% Fibonacci line of the May 23 to December 24 move, both at the same 42.74 level. Then the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39 and the July 23 high at 41.89, into a free area where the market created a small diamond continuation pattern. Now, the recent overall pattern had been the mid-August to early October bearish Andrews pitchfork. This had been pretty good at leading prices lower until we reached three bands of congestion below. They are the lesser Fibonacci line at 40.26, congestion at 39.86, and the February 2011 high at 39.53. I suppose in the big picture you could also include the neckline extension to the late May to April 2024 small reverse head and shoulders bottom, which is currently at 38.28. I know the prior three eroded the bearishness of this market, so I suppose this further one below may also have played a small role. Anyway, the move lower within the bearish Andrews pitchfork was fine until two things happened. The first is the construction of what can be seen as a triple or even a quadruple bottom over the November 25 to January 26 period, though I'm more inclined to look at it as a very, very complex reverse head and shoulders bottom. This bit was a subjective judgment on my part. I realise that, but I still see it as such. This pattern derived from and came from the previously mentioned November to early December last year diamond continuation pattern. The second occurrence happened 4 weeks ago, with prices breaking higher from this complex reverse head and shoulders bottom and punching up through the upper tine of the bearish Andrews pitchfork. Since that break higher, prices overcame the previously mentioned congestion band between 41.89 to 42.74 and over both the gold long moving average, which is currently at 41.55, and the mauve medium moving average, currently at 41.57, but stalled and turned lower at the end of January. Before dealing with that turn lower, it's worth noting the topside targets for that reverse head and shoulders pattern. Both the primary and secondary harder to reach targets at 42.47 and 43.07 respectively were reached right at the end of January. And what was especially satisfying about that move higher was how prices rose up to just over the combination of the 38.2% Fibonacci line and the 50% Fibonacci line of the May 23 to December 24 move, both, as I said, at 42.74, reached target X1 at 43.07, and the very next session, prices dropped like a stone, leaving behind a V-top at the end of last month. Thus, we are now back down in amongst the moving averages and late last week bouncing up and away from the very same broken upper tine we broke up through in mid-January. The question now is whether the market has the ability from a smaller base than the one that made the complex reverse head and shoulders bottom back in November last year through to January this year, whether it has the ammunition this time to overcome the overhead resistances, specifically the gold long moving average and the medium moving average, and then the eroding sandpaper of the July 23 high at 41.89, the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39, and that previously mentioned combined 38.2% Fibonacci line and 50% Fibonacci line at both at 42.74. Personally, right now, I don't think so. But that, of course, could change.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.